Hello, welcome back. So in this video, we're going to be taking a look at Micron Technology, which had its earnings report. And the earnings report was followed by a good reaction, and then today we're having a negative reaction. Like right now, as I'm making this video, the stock is down 4% about 2 hours before the market closes. And the first thing to do is take a little bit of a look at what has been happening in the 5-year chart, in which you can see that Micron is sitting right about the middle of what it has been, like 64 right now. It has been back in 2019, for example, like near 30 and also near 100, pretty much was its highest. So is it a buy right now? This is what we're going to examine, or we should be waiting potentially. First thing to examine is what happened during the earnings report, and you will see here that Micron Technology shares rose 3% in Wednesday, that's yesterday, extended trading session, after the memory chip maker reported better than expected financial results. And they reported still a net gap loss of $1.33 a share, narrower than the Zacks consensus estimate of a loss of 1.57. So they have been losing money recently, and you can if you remember it, the same thing happened in the previous quarter, where in Q2, company expected to report negative gross margins for the first time in 15 years. So we are finding the company in a place where they are sort of like losing money right now, a little bit narrower than expected. And you will see here that the computer memories company financial struggles underscore its difficulty navigating a weakened consumer economy, high inflation, and inventory troubles. And so they are expecting to report a write-down on inventory amid industry-wide component and supply constraints in the industrial market. So this may be a temporary thing, and this is why it's worth examining in a little bit more detail to see whether the company is a potential buy. Now, the PE ratio currently negative because of the most recent quarters. For the most part, the company has been having significantly better PE ratios, less than 20 and many times actually less than 15 too. And the price to free cash flow is sitting at about 22. So this is fair as well, with the company buying back a little bit of stock also, which is nice to see. And their liabilities are not too many, and these kinds of companies like semiconductors, for example, are very, very cash hungry, so you would expect them to have quite a few liabilities compared to their free cash flow, but it's not that high over here, and the same thing is with the debt to equity ratio, so a pretty solvent company, which has been having its troubles. Now, their margins normally have been sitting at much, much higher levels of about like 20%, 30% here or more in some situations, but right now, again, they seem to be losing money. Okay, so let's take a little bit of a closer look at the financial statements. So the income statement first. And you will see that the revenue of the company back in 2018 was 30 billion. And so it went down a bit, like you will see 2020, 2019 because of the pandemic years. Then it started climbing again, sort of like near approaching the end of the pandemic here. And back in now in 2022, the fiscal year, these things are getting better for the company. And the same story with their net income, yet we are still far from their highest. And so we had a few years where the company has been slacking here, 2019, 2021, haven't been their best, although we seem to be creeping upwards right now. And in terms of the balance sheet, what is the company doing there now? The total equity of the company from 32 billion to 49. So it's nice to see that they have been increasing that without actually issuing tons of stock. And also liabilities of about 16 billion right now, increasing about at the same rate with the total equity here. Now, in terms of the cash flow, the net income from 14 billion to 8.6 right now, and you will see that the operating cash flow from 17 to 15 here after the adjustments is still positive for the company. And if you exclude the capital expenditures, you will see that the free cash flow of the company is sitting at 3 billion right now. The problem, and you will see it with the quarterly, is that in the most recent quarters, the company's cash flow has been negative. And the same thing with the net income. Again, our tool can actually show you the quarterly as well. And you will see that recently the company has been losing money. So they have been making negative net income here, which is not nice to see. But again, we kind of know what is happening here for the company. Let's take it back here to the annual one. So the thing that I want to take a little bit of a look at before we proceed to the discounted cash flow model calculation, I want to take a little bit of a look at our stock news module and see what other articles, what are people thinking, what are they talking about in regards to Micron. And this is a very, very important piece of information, some important pieces of information here that the tool can give you give you sort of like a sentiment about the company here. So Micron recovery debated by analysts as bottom is called in memory chip market. And the reason why it was higher yesterday, Micron gets a repeat buy rating with AI to drive disproportionate growth in memory as supply tightens. And so, again, sort of like considering the AI things these days, so everybody, when companies are talking about AI, they tend to climb higher. This is the current norm right now in the markets. So this is important to see. Now, there are some articles here that are a little bit more bearish here, like micro investors shouldn't rejoice, is what they're saying here. And chip stock brushes of a stellar quarterly report. Micron technology reversal is imminent, is what they're claiming here. So you can kind of see sort of like the sentiment here within these articles. Now our social trends module here shows you movement in stock tweets, and you will see that there is an increase in comments, likes, and impressions. That's the increase here, like 400%, 274%. Yet the sentiment seems to be going down. Now, yesterday's sentiment was a little bit more positive, understandably so, again, since the company is down right now. In terms of the dividends that the company is paying, you will kind of see that there's a little bit non-canonical here. So some steep increases, then some slower increases is a dividend that I wouldn't really, play the company, like buy the company for the dividend at all. It's a very low anyway. It's like less than 1%, as you'll see here. And also, if you go back to our metrics page, you will see the payout ratio, which is sitting at about 16% of the free cash flow. Now the net income recently has been negative. Yet it's, as you can see, it's basically very, very easy for the company to pay all the dividends back to shareholders. They won't be having any trouble, but again, the dividend yield is fairly low as it is right now. So let's take a little bit of a look at our discounted cash flow model now. Let's see whether the company is a buy, whether it's worth buying. Now, you could always use a dividend discount model, but this is not a company where using that model would make a ton of sense because they are not paying much of their free cash flow back to shareholders. It's just a small portion. So it doesn't make too much sense. You generally want to be using this model when the company is paying most of its earnings back to shareholders. And so what we're going to do is use our stock evaluator, the discounted cash flow model. And again, you will see that, remember, the net income margins of the company have been highly up and down pretty much, so very relative compared to the year, basically, that we're examining. They used to be much higher, so I'm probably going to go with something that is around the average, the 5-year average, like 27%, just letting you know. And of course, I'm using the handy little table here, which gives you very, very nice information here for using with our projections. And remember, all our Patreons, all our members in Patreon have access to this too. Basically, they can do whatever I'm doing here, plus use all the other modules that are around. And you can find a link in the description box below this video if you're interested, or just visit myinvestorsheaven.com. And so, the revenue growth of the company, the average has been 11%, 11.6%, but again, they have had negative years. Now, we're kind of coming back, but we're still sitting at the revenue that the company had back in 2018. So I'll have to be a little bit more conservative here, and I will be using something like 5, 6, and 7%, which may still even be a little bit higher than most people would anticipate, but 5, 6, 7 probably makes some sense. And in terms of the net income margin, as I said, I'm going to be using something close to the 5-year average. And so I'm going to go 25, 27, and 28, just for the best case scenario. And the free cash flow margin that I'm going to be using. Now, the free cash flow margin for this company is typically less than the usual, typically less than like 80%. So I can be a little bit more conservative here, go something like 70, 75, and 80% here of the free cash flow as a margin. And this could also be a little bit too high. But again, this is highly variable because of what the company has been doing in the past few years. And it can be super variable for a company of this sort, which is actually potentially using a lot of its free cash flow, a lot of its operating, I should say, cash flow for capital expenditures. Again, cash-hungry companies here. And so the annual return that I'm going to be using is 13%. And of course, if we want to be super precise and super I should say conservative, maybe we could be using like 50% here, or 50, 55, and 60. Again, The users of the tool here can try their own projections. Let's just try some better scenarios here and see what we're getting. And hit calculate, and you'll see that with these scenarios, the current price of the company is sitting at $64, and we're getting a max price to pay of 81, 97, and 113 here, indicating that the company could potentially be cheap over here. Now, again, remember the free cash flow margins that I used are a little bit too optimistic. And so this is why we're potentially getting some good prices to pay here. If we go a little bit closer to what the company is generating, you will see that the free cash flow margin is probably sitting around 40%. Again, highly variable. But let's try that. Let's just say that we want to be like super conservative since we're already getting like green over here, and it should be a buy. What happens if we go as conservative as possible here, pretty much, and then we hit calculate? You will see that we get a little bit of a different story, hence not too far from the current price, still kind of far, but not extremely far. So sitting at 64, it's a company that could potentially be a buy, especially if it, if it comes back to its normalcy. But frankly, for me, I would potentially think that this could have some lower prices to give to potential investors here. Maybe not, but based on what I'm seeing here in the price action as well, I wouldn't be surprised if this goes down a little bit. The sentiment seems a little bit variable here. So at 64, I don't think I would be entering this one. Maybe over here, for instance, where it was like 50, it would be a much more interesting case. But right now it's higher than this level, maybe 64. Again, I don't think that even buying over here is a terrible thing to do, frankly. But I think that there are potentially better opportunities. Now the current market is getting a little bit more expensive, but maybe I just want to avoid this one for now. Just maybe potentially wait for it to go down a little bit. But you can tell that this has been kind of cheap for a while now. You can kind of see it here in the price to free cash flow, the price to earnings ratio. Although, yeah, the past few quarters suspicious, and so this is why we could potentially want a little bit of a better price as well. Thanks for watching. Tell me what you think about Micron, guys, and I'll see you in the next video. Bye-bye.